Hello and welcome to the Monday Futures Market Outlook for May 21st, 2013. This is Patrick Serezna. As always, we start off a chart of the US dollar index futures, and we've been looking for buying opportunities along that 81.50 support over the last month, and now subsequently have caught that breakout on the upside. The US dollar remains predominantly in trend, and while we certainly have approaching some of the upside targets toward the 85 level on the upside, at this juncture, if there is a technical breakdown in the euro, there is room for this dollar index to still trend substantially higher from these current levels. So we remain bullish the US dollar, looking for further strength. So next year, when we take a look at the Euro FX futures and look at the way that the euro continues to weaken, we're consolidating along a major support line, creating almost a head and shoulder style pattern on this chart along the 127.50 support. Really at this stage, the euro is consolidating around the 129 level. But if we see any catalyst news event that drives new weakness down below the 127.50 area on the downside, it would really open the window for a considerable breakdown in the euro back down to the 2012 lows, even as low as 120 on the downside. This could be a very big trend move of the year, but really at this stage we have no evidence that the breakdown move has begun, and so we want all of our members and listeners to watch that level. If we get a bounce off there, then it may neutralize it on the short term, but a breakdown at this juncture certainly does allow that US dollar to rally and the euro to weaken in this cycle. Next year, I want to look at the 30-year Treasury bond, and we've had a pretty deep throwback off the highs along with that 150 focal point we have along the upside. This is a very deep retracement, but it could still very well be exactly that, just a retracement back down to the lows. At this stage, if we have any indication that a short-term low is in, there's plenty of room for the 30-year Treasury bond to be a buy off the support and a rally back up to the highs. Next year, we're going to take a look at copper futures. Copper is getting a good bounce off of that short-term double bottom low along the $3 level on the downside. Really at this stage with this kind of a bounce, there's plenty of room for even copper to have one more swing up to 345, even 350 on the upside, approaching those November lows that were put in. At this stage, even if there is some short-term strength, because we are so bullish on the US dollar, into the period where the currency will actually act like a wet blanket, holding copper lower and potentially rolling it over to the downside. And so while there is definitely room for even as much as 15 cents on the upside during little short-term multi-day thrusts, we do believe that copper is vulnerable to potentially break down. Next year, when we take a look at crude oil, crude is sort of stuck in a sideways range for the last year, and really has been reluctant to break this almost $15 range between 85 to 100, always coiling in tighter and tighter. At this stage, with a rally up to the top in the range, the risk-reward proposition of oil is pretty poor, as U.S. dollar pressure will probably have it gravitate back to the bottom of the range, with no imminent breakout of this sideways range. So really, we're not outright bearish crude. We're simply at the top end of our range, which has plenty of room from a risk-reward proposition to trade to the bottom end of the range. Next year, I want to take a look at gold futures. And gold, there is speculation that we may see a double bottom along this 1350 level. But really at this stage, if this 1350 level doesn't hold, there is room for 1300, 1250, or even 1200 on the downside of gold during another leg lower. While we certainly have been trying to be buyers of gold at key levels, there is a lot of technical weakness at this point, and there's no imminent evidence that a bottom has actually been banged out and is in. We're going to be very adamant to want to try catch the buy on dip bottom on gold, but really at this stage we first need to see where the bottoms come in, and gold remains vulnerable. Finally, when we take a look at the S&P 500, we've now exceeded all of our upside targets for the year, which laid even at the 1650 level. Right now, with us trading much closer to 1670, there's a lot of bullishness in the air. A lot of the bulls very optimistic about the outlook for the S&P 500. Really, at this stage, we have now reached the parabolic state of the S&P, where you can see by the blue lines I marked that we're actually accelerating to the upside rather than maintaining a more of a steady pace. This acceleration actually increases the likelihood that we're very close to a market top, and no matter what the talking heads on CNBC are suggesting, really, though, with this kind of acceleration, there's nothing stopping the market first from thrusting even higher to 1700 or maybe even as high as 1750 off of just sheer euphoric buying at any cost. One way or another, whether the S&P manages to muster up to those top end resistance or whether it comes off this existing level, really at this stage we are looking for a significant market reversal at some point that even has as much as a 20-25% chance of actually developing into an outright market crash. While again the probabilities doesn't suggest a market crash, it's certainly something that is becoming an increasing probability by the sheer rate of which we're rising. At some point when traders realize that the music has stopped and they all run for the exit door, the bottleneck effect usually creates that big exit on the other side. At this stage we are reluctant to endorse anyone owning this market long. If you are a swing trader, you can clip all sorts of different trades on the upside, but for investors it certainly is a bad risk reward proposition. Just to review our key intermarket observations, we remain bullish the U.S. dollar and looking for a good uptrend. That certainly puts a period of pressure on commodities, which should give us a very neutral outlook there. And the U.S. bonds remain in an uptrend, even in spite of all the negative sentiment toward them. And really at this stage, there is still room for yields to go substantially lower as stimulus may continue to be plugged into the system. As for U.S. stocks and global stocks, we continue to see a very poor risk-reward proposition without there first being some sort of a proper market correction that gives a buy on dip. And certainly it's like a broken record where we've been looking for these buy on dips, and it certainly hasn't happened. But it certainly does not make it a good idea to chase the market just because we haven't had the buy on dip. At this stage, the longer this market stays overbought and overextended like this, the greater the probability that at some juncture it will counter a trend move. That was your Monday Futures Market Outlook. Thank you for joining me.